Welcome to Total Money Management. Steve's phone's kicking us off with a ding. There you go.
What? What am I doing?
Did you not hear that?
No.
The phone's dinging in the background. Oh, as always, back with Steve and Jacob. Terrible twosome. How you going?
Yeah, good, mate. Good. How are you? Happy New Year. Happy New Year. Even though now, what is it? It's like late January or something.
It'll be late
January.
Out, yeah. Just when we record.
But yeah, this is the New Year's edition.
Yes.
The transition.
Yeah, well, we haven't taken over Greenland yet.
Not yet. No. Or Canada.
Yeah.
I see Australia got a mention too. They were thinking about knocking us off too.
It's going to be a fun year, I reckon.
We should take New Zealand. Really? We should.
For what?
Yeah, we should take over New Zealand. Then we can work through the islands.
For the
Papua New Guinea,
speeches.
Samoa, right? Knock them all off. Just put them all in our basket. We give them all money anyway. They're all relying on us anyway.
I'm queuing the social media people going,
Outrage.
Yeah, that's ridiculous.
Well, maybe there'll be some people who actually say, "Steve, great idea."
Yeah. I mean, look, anyway, let's bring you back to market. So last year we had a good year in America.
We did.
And another one.
Yes.
We've been talking about it being quite expensive, and we've actually been getting some people agree with us, like it or not.
We'll change our tune.
Yeah, we'll just tell everyone to keep buying. Just keep buying. We'll be
Dollar
right.
cost averaging. Works every time over 40, 50 years, folks.
Yeah.
But anyway, yeah. What? Oh, chart, mate, chart. You've got to put the chart up.
You frazzled me.
Oh, you're a bit slow. Righto. What do we got there? That's just what we like to do every year is have a look at the summation of the previous year, particularly with asset classes, because as a general rule, we like to look for things that are cheap. Yep. That means you usually look at the things that haven't done very well rather than the things that have smashed it out of the park. Mm-hmm. So, what you can see there, if I can look at my blind eyes, one of the things that really stands out for me is commodities are quite cheap, and they have been cheap for a while.
They haven't done very well over the last few years anyway.
No, well, they boomed with the China stuff, right? Yeah. We went gangbusters in the mining boom, and I think it was about 11, or I thought it was maybe a bit later, but that was when they really came off the boil in Australia. And so you can see there that 211 to 24, they've been minus 12. So, it's been a pretty sort of sad show with commodities. What else? There's nothing really other than... Oh, mate.
Everything else is going
Mate, how's Bitcoin going?
Oh, I've done all right, yeah.
It's done 315 zillion, 362 million, 552,000%. I still think of that. Remember that guy who bought pizza and he paid 2 Bitcoin for the pizza or something?
He paid more than that, mate. Yeah, he paid a lot of Bitcoin. I think it was
But there you go. I mean, basically that's what's been going on for the last decade.
Yeah, the last 2 years have been crazy.
Yeah. In US stocks.
Yeah.
Only in US stocks. Emerging markets have been fairly dull. What else? Europe's been fairly dull, and that's probably part of the major concern I have going forward is the US has just absolutely dominated, to the point where I don't think I can recall seeing a period where the US has outperformed everybody so substantially. It's just murdered Europe, emerging markets. And you can see why everybody's in the US and why everybody's in the Mag 7.
Yeah, I mean, even doing a bit of research, even if you take the Mag 7 out, it's done really quite well.
Yeah. Over that, from the 2009 low, the bull market, the secular bull market, it's just been a stonker. The only bad one was 18, I think, and 22. They were 2 down years. But even then, 22 was pretty bad, but then, of course, 23 smashed it and 24 smashed it. So
yeah. Well, look, the commodities comment, it lines up with the new normal, what we've been talking about for probably lightly over the last 6 to 12 months-ish.
Yes.
But the fact that I think energy deserves a bit of a highlight over the next few years as well.
Yeah, I think we've got that on Monday, haven't we? Yeah, energy on Monday is that the energy sector is... What's that?
So you see what I did there? Keep us moving.
Lovely segue, folks. The energy sector I think has been cheap for a while. I think there's a few it's always hard when things are down and everything else is moving up. It just feels really, like you just feel like a bit of a nong brain when you're talking energy and everyone wants to talk about AI and NVIDIA and, stuff like that. And you're going, Warren Buffett's bought more of Occidental, and people are like, what? Who? It's like, that really old guy is worth lots of money. Nah, people who've come down in the last cycle. But I think the thing that strikes me about energy is the potential for a lot of upside. That's what
It's got a long runway. There might be a couple of bouncy years in there.
Yeah, I just think there's a potential, dare I say it, black swan, but there's a potential surprise event where, Russia drops a bomb or something goes off and energy spikes through the roof, right? Iran has a revolution or something.
LA sets on fire.
Yeah.
Something like that.
Something like that.
Too soon.
Well, it doesn't matter. That's just all Hollywood people burning. They're all insured. Who cares? Righto, Tuesday. What have we got Tuesday? This is a really important one, I think, because what I'm trying to do here is show people the argument. My argument why the Australian stock market has been really awful or, very average is because all the money's gone into property. So if you think in really simple terms, like an idiot like me does, there's two ways to get money into an economy. You have to have the private sector borrow, and that means either business will borrow or the general public will borrow. Now, the business will borrow to expand, which is what you want, okay? But what we've had is we've had 25 years in property, and that's been the consumers or the general public borrowing to buy mortgages to speculate.
So this is the productive debt versus unproductive.
Exactly. And the mortgage debt, buying existing properties, is unproductive. So in other words, it sounds great, but it doesn't add anything to GDP. We're not making anything, right? We're not making widgets or Doritos or anything. We're just swapping prices, right? So my argument is the reason why the stock market hasn't done well is because people have been borrowing for property, and the other one is governments have been running very small deficits or surpluses, so the government's not spending a lot of money. I know there's economists out there going, the government's spending all this money. Well, that's bullshit. The debt to GDP is like minuscule, and
Compared
now
to other countries, yeah.
Well, now I think it was yesterday or even this morning, Chalmers was in the AFR, Australian Fin Review, saying that with the increased tax receipts, it looks like they might run a surplus again. And what people don't understand is when the government runs a surplus, that means they're taking money from us.
Yeah.
When they're spending money, they're giving it to us. So I want them to give it to me, right? Which is go into a deficit.
In a good way, not a bad way
In a good way, yeah. So, but that's what I mean. The problem, and this chart is showing that. I think it's, what did my poor eyes say, about 2,000, which is what we talked about in the Property Problems special podcast.
Yeah.
Right? 2,000, everything goes gangbusters in property all over the world. Canada, America, England, and that's because that flood of debt money has gone into property, not the stock market.
Yeah. I wonder why they're not taking a leaf out of like the US's book and going, okay, we're just going to spend, build factories, create some more jobs and boost the economy.
The US, it's a bit of a funny one, because the US tends to be much more practical than ideological.
Yeah.
So you hear the Wall Street guys, they're carrying on all the time. Government debt, it's a nightmare, and we're all going to be paying, and our kids are going to be. It's all bullshit, right? They love it. Joe Biden's spending heaps of dosh, and I was just reading this morning where you look at Joe Biden where he's left the country. Now, don't write in, folks, and complain. All I'm saying is Biden has got a huge budget deficit. Rates are at 5%, so the rich are getting bucket loads of money from bond investments. The place is going gangbusters with business investment. Unemployment's actually falling. It's absolutely sweet spot. And they gave him the arse and put Donald Trump in, right? So there was one political argument that said, you want an economy that's good, but you don't want it so good where people go, all right, we can give you the flick and try this other guy.
Yeah.
So, but the difference is Australia's been locked in this garbage about neoliberalism, but what it really means is no one likes the government. And so the government's not, if the government spends, you can hear it the last 2 years, they're all carrying on about the government deficit, right? Government debt is about 35% of GDP. In America, it's about 100. In Japan, it's about 270.
Yeah.
Right? So Australia's got a hell of a long way to go.
Well, that's the thing, right? The government can spend and people will hate them. The government can save and the people will hate them.
Yes. It doesn't matter what you do, mate. People will have a whinge. Right? So that's part of the problem. Albanese and Chalmers are sort of quote unquote not allowed to spend. And I think it's on Thursday. But just moving on, Wednesday, just showing you there again, Asian investors, why Australia's homes are now top target in the world for Asian investors. Slide.
I'm reading the slide. I'm reading it as it is. It's quite interesting.
Yeah, well, what we were saying in property problems, right?
Yeah.
Foreigners can come in here and just buy whatever they want. You can't do that in all the countries. And so the capital that's floating around the world is coming to Australia and the US and England, Canada and New Zealand because we allow people to come in and buy it.
Yeah.
Right? So I just wanted to move that on to Thursday. The reason why Thursday is really important is because, and I just want to read this out, okay?
Okay, go.
Because it's really important for what we talked about with property problems.
Yeah.
Now, in the new year, every new year, the public are allowed to get access to the cabinet documents that are 20 years old. So in other words, cabinet documents which are confidential, right? You can't see them for 20 years.
So every year, like a new one comes out.
That's right.
Yeah.
So 2025, so we can now go back and say, okay, what did Cabinet talk about in 2005 or 2004?
Yep.
Right? Okay. So Prime Minister John Howard and his Treasurer Peter Costello shelved a report that proposed substantial changes to their own tax reforms to fix spiralling house prices. Hello. Instead of telling Cabinet the reforms were largely a job for the states. Instead telling Cabinet. So in other words, they went, oh, no, we can't do anything. That's a job for the states, right? Even though they're the ones that introduced the tax reforms, right? So go figure. Documents released today by the National Archives from John Howard's Cabinet of 04 reveal a report the then coalition government had commissioned into problems facing first home buyers. Fancy that. Recommended winding back capital gains tax, hello Bill Shorten, and means testing home buyer grants. But Howard and Costello feared large property price swings and public anger if they tackle reforms. Shut the gate. That's why I keep saying it. Albo's not going to do anything about it because he knows it's a shite sandwich.
Yeah. Just kick it
Right?
down the cat.
But what I'm saying is here, these guys knew this like 20 years ago and they went, oh no. And that's why I've said our market is just beyond crazy.
When
right?
did the incentive come in?
99, I think.
Right.
Howard bought in
99, 2000.
Yeah, what happened was Howard was facing, I think it was Kim Beazley, and he really needed to get the economy going, and that's when he bought the first home buyers grant in. And I remember it. It was 15 grand, I think, which, back then was enough to catapult you.
Yeah.
And the other one for the rich people was the capital gains tax changes.
That's the one I'm talking
Yeah,
about.
yeah. Because, see, the rich people said, great, we can, here's my son. He doesn't own a home. He's going to get the first home owner's grant, and I'm going to, actually buy one as well and get capital gains discounts.
Yeah. And then since then, it's just gone.
And then it's just continued on. So it's just like stock market momentum, right? It just gets momentum. And, of course, what happened then was the states then said, oh, well, if you give them 15, we'll give them 7, right? And then there was all these stamp duty concessions, right? So it's just been pouring petrol on fire, right? And that's where the problem is, right? I can tell you, politicians are looking at this going, man, there is no way to stop this, right? Because nobody wants lower house prices. If you've got as I say, we've got 2.3 million landlords. As if you say to them, good news, Jacob, I'm going to drop your house price.
Yeah. Well, there's
Well,
certain,
Bill Shorten tried it.
yeah. Well, there's certain areas down in Melbourne and Sydney that have lost a couple of
They're
percent
starting
last
to
year.
now, yeah.
But people are talking as if the world's ending as well.
Yeah. Well, it probably is for some of them.
Yeah.
It probably is. That's what I mean. It goes on for so long, you think this is normal, right? That's the problem. And indeed, I think it's God, the segues today are magnificent,
We're
aren't they?
all over it.
Recency bias on Friday. United States percentage of respondents expecting stock prices to rise over the coming year, right? Is shot up
To almost 60.
So again, these markets get momentum, right? What do you think it'll be this year? It'll be great. Why? Because it was great last year and the year before, right? So that's what happens, and that's what we've been doing in property. It's been going well. It's been going well. That's had a little bit of a fall, and then it picks up again.
And you're like, oh, okay. Well, this is what happens all the time.
It's a part of the dip, right? It's fallen 5%. So, there's people now, property people going, Melbourne's a good spot. You should be looking at Melbourne. I mean, it's fallen a blip from what I can see.
Yeah, it's like,
it's not a 30% fall where I'm going, oh, man, actually it is really good value on a yield basis.
oh, the yields are still shocking.
Yeah.
Most places.
Yeah. Well, especially if rates are at, 4.5 for a cash deposit.
Yeah. Well, it's at least in the US market, you can hedge.
Yeah.
In equities, you can hedge.
Yeah. And that's one of the I think, many advantages, right? You can hedge, you can rebalance, I just think it's a lot better. But, you can still make a lot of money in property. My argument is, you're just using leverage. You're using leverage in a bull market. Go and buy a leveraged ETF in, 2009. I can tell you the return is about 1,000% in the US.
Yeah.
It's absolutely insane. and that's 3 times leverage.
Yeah.
You imagine doing property at 10. It'd be like buying an option, a long-dated option for 5 cents.
Yeah, I mean, but the banks are like, oh, here, we'll loan you 800 grand to buy a property. We won't loan you that to go into leverage. ETF,
you've got to do a margin loan.
Yeah. Oh, they'll laugh you out the door. Anyway, what's in the bonus?
Righto, in the bonus. Oh, this is the country returns. Now, this is in US dollars.
Yes.
Okay, so it's not local currency.
Argentina.
But again, what we say is, I would be looking at Brazil, Mexico, South Korea, Indonesia, blah, 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 rather than looking at Argentina, Israel, the US, Singapore, right?
But the RGs were not doing so well a couple of years ago, right?
What's up? Sorry?
Yeah, Argentina.
Yeah.
A couple of years ago.
Well, that's a currency issue.
Yeah.
Since, what's his name, Miller came in and said he wants to get inflation under control. So there's I think a lot of that is generally a large currency move, and you've got to allow for that, because if you look at Australia, it's got 1.6 in the middle of the second column there. Well, our return was actually about 11. Right,
taking into account currency.
So you've got to use the currency as well. But again, just interesting to see the returns. I'm always attracted to the ones in red. Then you go and look at the CAPE ratio, which I think we're talking about next week.
Yes.
They come out. Brazil's pretty cheap. Mexico's pretty cheap. South Korea's pretty cheap. So, that's where you want to be looking, rather than going, I'm going to throw more money at the US.
Yeah. January gets me all excited, because that's when we make the moves.
Yeah. It's when you actually do something.
Yeah, and the rest of the time you just sit there. Oh.
Listening to me waffle on.
No, it's all right, mate.
Yeah, well, you only have to do it every fortnight. What have we got here? China. Oh, yeah. Righto.
Do you want to talk about China?
Oh, God. It's just getting worse, I think. What I'm doing there, again, is just keeping people in touch with the US-China stuff. And I think that's going to be a really big issue this year, particularly when Trump gets in.
Yeah.
We've got some, now I must do a mea culpa, because I think a couple of weeks ago I said it was the Russians that dragged a infrastructure cable, communication cable, but it wasn't. It was the Chinese, I think.
Oh, okay, I see. Yeah.
So again, there's a war going on, and the big one is up in the Arctic, and that's why Trump's on about Greenland, right? Because the Chinese are working actively around that area with Russia, and it's got a lot of strategic importance, right? Shipping lanes. Greenland's rich in minerals, and they suspect, I'm not sure if it's confirmed, but they think there's a lot of oil.
Yeah, but it's a way to annoy, just to piss Europe off.
What, from China's perspective?
No, from the US's perspective.
Oh, yes and no. I think the problem Europe, for me, is Europe's got no, they've got no gonads, mate. They've just relied on the US since the war. And now the US has said, well, we've had enough. And Europe's like, oh, my God. And it's like, well, guys, you should have been looking after your own bloody backyard. Canada's doing the same thing.
Yeah.
That's why Trump's having a shot at Canada, because he says, you guys are sitting up there, you're doing nothing in terms of military spending and stuff, but you want us to run around the bloody world, protecting everybody's sea lanes so you can all make money.
Yeah.
And it has to stop. And it's pointed out, this is when they've gone, okay, we've had enough of this. And now everybody's up in arms about it. But it's, you know what I mean? It's
it's against it's not kosher. It's against the grain as to what everyone's used to.
Yeah.
Trump, it just feels like he's taking shots unnecessarily.
Yeah. But everybody, Jacob, is having a shot at the US. But then when you say, all right, step up to the plate, they're like, oh, it's just really difficult for us. And it's like, okay, so, how do you want it? Do you want to look after yourself, or do you want the US to come in and fix it for you? But then you want to sit around and criticise the US.
Yeah, but here's the price you pay.
They're a crazy bunch of bastards. But that's why I'm not that critical of them, because if hell comes to Australia, mate, the first person I'm calling is Donald Trump, right? Because they got all the hardware.
Yeah.
Right. So
All right, let's spend a bit of time on rebalancing, why we rebalance. This is the lesson of the week as well. We're getting a few questions in the socials and just generally across the community as well, but I thought it'd be good to spend the next 10 minutes or so talking about this.
Yeah. It's just I'm just trying to simplify this. There's a thing called volatility drag, right? And it's mathematics. It's not, anyone's special formula. It's simply the way the geometric return works, okay? And down the last line there is important, right? The sequence of returns.
Yes.
So what I'm trying to point out here to people is the reason why I'm really cautious at the moment is because if you have a 50% fall, you lose an absolute bucket load of money, right? So like I said, the market's gone up in the US about 470% or something. Let's make it 450, right? Okay, a 50% loss means takes you back to 225% return from 09. That's a lot less spectacular than 450, right?
Yeah.
But my point being, the volatility is the thing you want to watch, because that's the thing that affects the geometric return, right? So I'll just read through this. Negative numbers and compound returns. So you make 20, lose 20, average is 0, right? So you go from $1 to $1.20. If you calculate, intuitively you go, up 20, down 20. Okay, back to the start.
Yeah, it's not.
No. With the geometric, so it goes from $1 to $1.20. A 20% loss of $1.20 is 2 times 12, right? 10% of $1.20, right? 12. Now you're back to 96 cents.
So you lose 4
cents, right? Even though the average is 20, right? And that's the central point I'm trying to make there. The second point I'm trying to make is when the way the sequence happens is really important. So the second part there is, if you have 3 periods of 5% returns, you go 5 plus 5 plus 5. Now, I'm saying 5 plus 5, right? 5 plus 5 plus 5, 15, divided by 3, 5. The arithmetic average is 5.
Yes.
Right? Okay. Now, that's not the way the stock market works. The stock market is 5% times 5% times 5%. So in that case, it'll be probably, the return will be 6.3 or something, right? Whatever it is. Now, let's change the average around. If you say, let's make it 6% in the first year, plus 5% in the second year, plus 4% in the third year. Now, I mean, it should say times there, really. Mm-hmm. That gives you the arithmetic average of 5, right? 6 and 5 are 11 and 4 is 15 divided by 3.
Yep.
But if you do the geometric thing of 6 times 5 times 4, the compound return is 4.997. Now, that's silly because it's really low. Mm-hmm. Now, if you expand it out and say, right, 9% in the first year, 5% in the second year, and 1% in the third year. 9 and 5 are 14, average, yeah. Right? Same thing. Now, but the compound return's now 4.949. Mm. So the average, and like you and I talked about it a while ago where we said, double and then lose 80%. And you go, okay, 20%. No. You've actually got $36 left.
Yep.
Right, because you're taking a loss of 80% on 200.
Well, I think that's the key point because there are a lot of people now. There's big change of hands in Australia, particularly in super, and just with boomers that are selling their properties and equities and that kind of stuff. So if there's a large drop, and a lot of that's in the US, right?
Yes.
So they've had a good few years and made a fair whack of cash. If there's a 30 or 40% drawdown on that,
yes,
it's so significant,
absolutely,
to get back to where you were, and it means that you can't actually retire, quote unquote, or stop trading or investing. You have to continue.
Yeah.
And that might be another. If you look in Japan's case, there's a great chart I think we might share in the next couple of days where now in their equities now they're just getting back to break even after 20 years.
Yeah, after 30 years.
Yeah.
That's what I mean. I think I recited this story before, but a neighbour of mine was out, swinging the golf club, and I said to him, "G'day, mate, how you going?" He retired, and he said, I'm back at work. And I went, "Oh, yeah, what for?" And this was after the 30% decline with COVID, right? I think it was February.
Yeah.
And I said, and he said, "Yeah, I'm back 3 days a week because I lost 35% in the COVID decline." Right? Now, people will say, "Oh, yeah, but it turned around the next month or so." And it's like, well, yeah, but that's not the point. The point is he was going, well, I needed this money. And he went back, I think, for another 12 months. And I'd spoken to him, I think it was May or something. And he said, we recovered some of it. But what we were just talking about was the point. When you lose 35%, you've got to make 50 or so to get back. Right? That's the problem. It's magnified in an up and down directions. So, the old story, you double and halve and you're back to where you start.
Yeah.
Right? So a 50% loss to start with means you've got to double to get back to where you were. Right? And this is why we say don't lose money.
Yeah. So circling back to that's why we rebalance.
That's why. Bingo. That's why you rebalance. It's a pain in the ass because you rebalance and the market goes high and you go, oh, man. Right? I can tell you, it doesn't matter. Just keep rebalancing. The profession does it anyway. They rebalance your portfolio every month.
Yep.
Right? They just don't go on about it. And part of it is, I think, because they're saying to people, buy and hold. And it's like, oh, okay, well, why are you rebalancing my portfolio if I'm buy and hold? Shouldn't you just leave it? No, because they know that rebalancing is the secret.
Yeah.
Right? Why is it? Because of the volatility. That's the reason why. Okay, so again, it's a really, really important point. And the reason why I'm saying that now is because we've had a great market run in the US or we've had a decent year in Australia. Rebalance your portfolio. And if you say, oh, how much? It's like, well, that's more art than science. So long as you rebalance. If the more you've made, the more you should rebalance. Right? If you've made a ton, right, rebalance half a ton.
Yeah.
Right? If you made a little bit, rebalance a little bit.
Yeah.
But that's the sort of important part of it.
Or just give Steve a message on Instagram.
Yeah, or just give Jacob and he'll put it into Bitcoin and you'll make, what'd you make, mate? 346 million%.
That's all right.
Easy peasy.
I'll pay for the private jet's fuel this year.
Yeah, thank you.
All right, well, let's leave it there unless you got anything else to add.
Nah, mate, that's it.
Perfect. We'll see you next week.
Cheers, folks.
As always, remember, we don't provide financial advice.